So I think international trade will experience a period of slower growth. How long that period of slower growth occurs depends on how quickly supply chains adapt. That is likely to have a big effect. The slowdown in investment is likely to have a bigger effect on U.S. economic growth than the direct effects of the tariffs. It's really hard for governments to swim against the tide of comparative advantage, and the positive forces of cooperation and coordination are likely to bring us back at some point to a conversation that results in a successful reform of multilateral trading rules. So I think the current trade, both trade and domestic economic policies and his sort of geopolitical policies are likely to result in the U.S. economy experiencing slower growth going forward. The U.S. economy has been a rather dynamic and innovative economy for the last 10 to 15 years, except like during COVID. But his policies are creating a lot of uncertainty both in the domestic and the global marketplace. So tariffs will raise prices for goods, but also parts and components that many firms use to produce other goods, including some that are exported globally. And the uncertainty as to what the tariff levels will be or what the relationships will be with other countries have caused many domestic and foreign companies to hold off on significant economic investments in producing new factories or making significant investments in new kinds of products or marketing approaches. That is likely to have a big effect. The slowdown in investment is likely to have a bigger effect on U.S. economic growth than the direct effects of the tariffs. So my work has suggested that the direct effects of the tariffs may take anywhere from 0.5 to 0.75% off U.S. growth. It'll also have negative effects on the global economy to maybe 0.1% or something like that. Now, there's already a lot of growth momentum, so U.S. growth has been almost 3% in the past year. So 0.5 to 0.75% is not a recession. It's a slowing of growth. However, that's the direct tariff effects. Those indirect effects of tariffs on reducing the amount of investment in the United States economy, that's likely to bring about a bigger effect than the direct effects of the tariffs. We just have to see what firms are actually deciding to do about their investment decisions going forward. So I think international trade will experience a period of slower growth. How long that period of slower growth occurs depends on how quickly supply chains adapt. So one of the things we've observed with past shocks, whether it's been the great financial crisis or COVID, is that global trade is remarkably flexible and adaptable. And there's a negative effect from these shocks, but then global trade finds new paths, new directions, new trading partners connect. Foreign direct investment flows to different countries. But the effect on globalization overall really hasn't been to reverse it. It's been more to sort of slow it down or reorganize it. So who's trading with whom? New connections were made, and in the end, trade recovered as much as before. It's just that the trade connections were slightly different than they were before. And I suspect with Trump's tariffs, we're going to see that kind of reconnection among trading partners, although I do think trade with the U.S. will decline. So the U.S., it's not going to be isolated from global trade, but its role in global trade likely will be reduced. There'll be long-term scars, and it'll come from at least two sources. One source, as we saw in Trump 1, his policies were rather aggressive on trade and fairly unilateral. When he did not get reelected and President Biden was elected, President Biden kept a number, not all, but a number of those Trump trade policies. So I suspect in the administration that follows Trump some of those policies will be maintained. Not all, but some. The other aspect of it is the loss of the brand of the United States as a trusted trading partner. So the United States has been a backer and founder of this rules-based multilateral trading system post-World War II. And there's been a lot of goodwill towards the US economy as a place that's a good place to invest. It's a good place to draw on the capital markets there. It's been a safe place. It's been stable. It's been, it follows the rules. So if you're a company trying to decide whether or not to build a factory in the United States, you know what the rules are and that they're not likely to change on you on the last minute. I think what Donald Trump has done is created a lot of uncertainty around what the rules are for investing in trading with the United States are. And that creates a great deal of uncertainty, and it essentially reduces the brand value of, operate in America, right? And I think that's really going to change. I think many countries and many companies are going to be viewing the US with a much greater skepticism and worrying about the risk of policy changes that could threaten their economic activity. I do believe that Trump's trade policies are likely to result in more US manufacturing meeting final demand in the United States. So that's reshoring. I was skeptical of this, but the persistence of Trump and his tariff policies are likely to result in a relatively small increase in US share of production meeting US final demand, okay? It's already pretty high, so a lot of US final demand is already met by domestic economic activity, either manufacturing or services. Remember, we're largely a services-based economy and most consumption is services, but it comes at high cost. Producing more to serve the domestic market means you're reallocating capital and labor from existing opportunities to these new opportunities. And these new opportunities are probably not opportunities that we have a comparative advantage in. It's already demonstrated that other countries can produce these goods more cheaply than we can. So you can be successful in reshoring in terms of having a higher share of domestic production meeting your final demand, but that doesn't mean that you're growing fast, right? It doesn't mean that it's good for economic growth. I think many countries don't realize is that just because you produce a lot for your domestic demand does not mean you're a fast-growing economy. Most of the discussion around the role of the dollar suggests that it's going to remain the predominant currency for at least the next 10 to 20 years, but that other currencies are going to start playing a bigger role. That's not necessarily a bad thing. I do think there is a danger that this transition could come much faster, and that danger comes from a couple of different sources. One source is fiscal imbalances in the United States, where the US government continues to spend more money than it raises, right? So it's got a big fiscal deficit, and it's got to issue bonds, and many of those bonds are bought internationally. If foreign bond buyers become skeptical at the size of the US debt and are worried about how the US is going to manage this, does it inflate it away, or does it default? That's going to increase borrowing costs. The other dimension is one reason the US has been able to sell its bonds is because it's been viewed as a very safe place to invest, and people have wanted to be able to trade with the US to get dollars to be able to invest in the US. So the uncertainty around the fiscal deficit combined with the uncertainty about the US being a safe place to invest could undermine the role of the dollar in the global economy. I think those are the two big driving forces that I'm paying attention to. I think there are two inevitable forces. One's an economic force, pretty clear economic force called comparative advantage. It's really hard for governments to swim against the tide of comparative advantage, okay? And the other one is this fundamentally important role of coordination and cooperation around setting rules. And the positive forces of cooperation and coordination around solving global challenges are likely to bring us back at some point to a conversation that results in a successful reform of multilateral trading rules.